Hi. Let's learn about bailouts and how they work. A bailout is when a business, an individual, or a government provides money and/or resources to a failing company. These actions help to prevent the consequences of that business's potential downfall, which may include bankruptcy and default on its financial obligations. Bailouts are typically only for companies or industries whose bankruptcies may have a severe adverse impact on the economy, not just a particular market sector. For example, a company that has a considerable workforce may receive a bailout because the economy could not sustain the substantial jump in unemployment that would occur if the business failed. Often, other companies will step in and acquire the failing business, known as a bailout takeover. Allowing a company to fail can have significant consequences, both for the company itself and for the wider economy, as in the case of contagion. The U.S. government has a long history of bailouts going back to the Panic of 1792. Since that time, the government has assisted financial institutions during the 1989 savings and loan bailout, rescued insurance giant American International Group, funded the government-sponsored home lenders Freddie Mac and Fannie Mae, and stabilized banks during the 2008 Too Big to Fail bailout, officially known as the Emergency Economic Stabilization Act of 2008, EESA. Further, the financial industry is not the only one to receive rescue funds throughout the years. Chrysler, General Motors, and the airline industry also received government and other bailout support. In 2010, Ireland bailed out the Anglo-Irish Bank Corporation to the tune of €29.3 billion. Greece received European Union (EU) bailouts which topped the scale at around €326 billion. However, many of the businesses which receive rescue funding will eventually go on to pay back the loans. The U.S. government offered one of the most massive bailouts in history in 2008 in the wake of the global financial crisis. The rescue targeted the largest financial institutions in the world who experienced severe losses from the collapse of the subprime mortgage market and the resulting credit crisis. TARP allowed for the United States Department of the Treasury to spend up to $700 billion to purchase toxic assets from the balance sheets of dozens of financial institutions. By its end, TARP disbursed over $443 billion to financial institutions. Automakers such as Chrysler and General Motors were also knocked down during the 2008 financial crisis. The automakers sought a taxpayer bailout as well, arguing that, without one, they would not be able to stay solvent. Automakers were under pressure as slumping sales plunged amid the dual impacts of surging gas prices and an inability for many consumers to get auto loans. While intended for financial companies, the two automakers ended up drawing roughly $63.5 billion from TARP to stay afloat. A company may need a bailout if it is facing severe financial difficulties that threaten its survival, such as mounting debts, declining revenue, or a sudden downturn in the market. A bailout can provide the company with the necessary funds to continue operating, restructure its operations, and pay off its debts. The terms of a bailout will vary on a case-by-case basis. However, there will usually be set conditions or requirements for receiving a bailout, such as a restructuring plan or changes to the company's management and operations. Bailouts may also come with certain strings attached, such as limitations on executive compensation, debt limits, or increased oversight and accountability measures. A bailout occurs when a third party, usually a government or government agency, steps in to save a company or companies by providing them with capital, credit, and other forms of support. When a company accepts a bailout, it will often see its management team replaced and its debts restructured. The company may also be put up for sale. As a result, existing shareholders may not always be saved by a bailout. Here are 4 key takeaways. 1. A bailout is the injection of money into a business or organization that would otherwise face imminent collapse. 2. Bailouts can be in the form of loans, bonds, stocks, or cash. 3. Some loans require reimbursement, either with or without interest payments. 4. Bailouts typically go to companies or industries which directly impact the strength of the overall economy, rather than just one particular sector or industry. Hope this would help. Thanks for watching.